I'm Osborne Foreman, and in this week's portfolio update I'm going to show you the UK stocks I bought, as well as the top riser and faller in the portfolio. And if you find the video useful, moderately entertaining, that's the best I can provide on this channel, please drop one of these, support the channel. According to Google Finance, the FTSE 100 is up 1.97%, the FTSE 250 is up 2.60%, and the S&P 500 is up 2.58%. My portfolio has continued to consecutively underperform the markets, and actually I've lost track on how many times I've underperformed the market, but we must be at least over 4 weeks in a row. My stocks have only gained, or my portfolio has only gained 1.99%. Yeah, I'm not going to worry that I'm underperforming the indexes, as I believe that this is the short term and there's a long way to go in my investment time horizon. I also believe that a majority of my portfolio is temporarily out of favour. We've seen this transition from growth to value stocks. People are selling out of these growth stocks, these high octane growth stocks, selling out of these, transferring their wealth into value stocks. As most of my companies has been seen as pandemic resilient stocks, or even companies that have benefited from the pandemic and subsequent lockdowns happening. So as we are nearing the end of the last national lockdown, as it is largely speculated due to the high proportion of vaccines in our country, more investors are piling their money into companies that are set to recover from the pandemic. And whilst I would completely agree with this sentiment 1 year ago in the peak of the pandemic crash, or perhaps a few months after as those stocks barely gained traction, I feel that now is not the time to be buying these recovery stocks. I feel that growth stocks are out of favour currently. Thus, the likes of the FTSE 100 and FTSE 250, which have their fair share of value stocks, are increasing, and therefore my portfolio is falling behind. I'd like to take this opportunity to react in an opposite way to what the markets are doing. Right now, people are selling growth, buying value. I personally would like to put my wealth into the growth stocks that are experiencing a correction, as I feel that eventually this will turn around, as we see this as typical cycles as a market investor. Investors are potentially trading out of their growth stocks to buy into these value stocks, and that creates a kind of chain reaction in which these growth stocks continue to fall. This causes people to panic, sell more of these growth stocks, and then they'll see these value stocks that look attractive, they've been increasing, the fear of missing out will kick in, creating perhaps a negative feedback loop in which the money is going from the growth stocks into the value stocks. For example, the likes of Games Workshop, a company that has retail stores, and thus you would have figured prior to the pandemic that they may struggle if that sort of situation or crisis had occurred. However, they were saved by their online retailing, in which that had proved really resilient and in fact grown their bottom line. This had meant that they had been doing better than expected, benefited well with their share price or valuation during the last year, and thus we'd seen their shares double since this time last year. Since they've also made a majority of their shareholder returns in the last 5 years via price to multiple expansions, I may expect that this may not continue to happen. They've been negatively impacted by the sell-off of growth, as they are now a higher valuation stock. I'm going to make quite a bold claim here, and I'm going to expect the worst but hope for the best. I expect that Games Workshop shares may not move, or they may stagnate or trade sideways for the next 5 years. I think this is not a terrible, but a bad case situation, but not unrealistic to think about. However, if shares go up, then I'll be happy because I hope for the best but expected the worst. The point being is I don't say this to create fear amongst investors. I'm not saying you should sell your GAW shares right now, because that's not really what I'm after. I'm trying to say that at this point in time, you shouldn't be fixated on what happens in the next 5 years, but rather look to see what may happen over that longer term period. Therefore, if shares were to stagnate for the next 5 years, I would continue to use this as an opportunity. I would continue building my position with Games Workshop, despite shares perhaps not moving much, as I believe over the longer term they will move. Providing their earnings and revenue growth continues over this time period, they will only become more valuable, as their price to earnings ratio will start to drop further, same with their price to book ratio. Thus, I would be happy to continue buying shares of Games Workshop, even if they remain out of favour, as I do believe eventually in the future they will once more become in favour, especially if they continue growing at the pace that they have. My true concerns would be the likes of the businesses that are struggling, yet valued at very premium valuations compared to where they were this time last year. And these are based on almost ridiculous valuations on the expectations of a very strong economic recovery with pretty much no setbacks. These might not be poor quality companies per se, and in fact these could be very good companies that have certainly been disadvantaged by the pandemic. However, what I can see happening in the markets are people are pricing up these stocks. They expect things to go flawlessly, and it doesn't seem that they've priced in a mistake. JDW or Wetherspoons certainly comes to mind in this category. As far as I'm aware, they've not sold a single pint this year, yet they're nearly trading back to where they were prior to the pandemic crash. Sure, I mean, I think they're down about 10-15% from their highs in December 2019, but this is still quite a high valuation considering that they have got a lot of debt on the balance sheet and are not even open at the moment. I'm not saying that this company will fail. Neither am I saying that JDW won't see a benefit from the lockdown easing and perhaps increased levels of consumption as people start to spend their savings. But I do feel that they are valued too highly at the moment. I feel that are valued at a premium based on the expectations of a near perfect economic recovery. Thus, I speculate that we may not see much share price growth from the current valuation of the current share price it's currently sat at. What happens if they release their full year results for 2021? Yet we find out that they haven't performed as good as expected. Sure, people are most likely to be expecting losses overall, in fact probably another decline from the year prior, but we may be hoping that they will do better than expected. What if it really doesn't do well? Are investors going to continue buying, or are they going to perhaps panic sell? And this isn't against the long-term holders of JDW, as if you've likely bought earlier in the year, then you've likely gotten a good value on your investment. But I feel at this current valuation, it feels like it's perhaps topping. However, please remember that I'm speculating, and I'm the same person that bought shares of SMWH or WH Smiths at £10 per share, sold at £9 per share 2 months later, and they're now trading at nearly £20 per share. So I'm in by no way, form or shape, I've said that in the wrong order, in any way a financial professional, nor do I really know what I'm talking about. Before getting into the top risers, I'd like to take the time to mention that I've created a Patreon. In honesty, it's to help the channel's sustainability so that I can draw more of an income from it, with hopes that in the more distant future that I could then solely focus my attention on the likes of YouTube and the content I provide. However, I've designed the benefits to be as high value as possible, as I am a value-centered person, well, perhaps with products rather than stocks. The idea is that I would like to pay a good price for a quality product, and so that's what I've hoped to create. I've given the potential benefits of my portfolio activity, meaning you would know the updates and changes in my portfolio prior to these updates. Furthermore, I will be doing daily updates on that activity if I buy or sell the investments, my exact price per share, and my holdings at the end of that day. However, if I don't make any share purchases, then there perhaps wouldn't be an update on that day, for example. I've also created an exclusive Discord role, and yes, I do have a Discord server with over 340 members. You're more than welcome to join. However, there would be an exclusive Patreon chat which you could join and interact with myself. Furthermore, there's also the likes of the monthly stock analysis. As you may know, I have stopped doing video stock analysis on the channel. However, I'm going to be doing monthly stock analysis write-ups, and so if you're interested in that, it would be worth signing up. However, do bear in mind I have not created any yet, and I do not wish to mislead you, but I hope to get one done in the next week. If you wanted, you could sign up for free using my link in the description down below, and if you cancel it before the end of this month, you will not be charged. So if you find out that perhaps this isn't to your liking, you can cancel it with at no cost to yourself. Unsurprisingly, the top riser in the portfolio once more is Ashted Group, with shares rising by 6.28% this week. This is my only value stock exposure, and therefore it's likely benefiting whilst the rest of my portfolio is not, as they are high octane growth stocks. I think AHT is a useful indicator in my portfolio in telling whether the market-wide growth is from perhaps value stocks individually, or if growth stocks are out of favour. And I can see that because AHT has done very well, whereas the rest of my portfolio during the last month has really dropped quite a considerable amount. My position is now up 64.82%, and I still hold 40 shares, despite selling 5 shares about 2 weeks ago. I did this to trim profits, as I wanted to top slice a position as it has done really well and crystallize that so that I could reinvest in a more beaten up growth stock. I plan to purchase more of Ashtead Group when I feel the time is right, and this time would be when people are then selling out of the value stocks and buying into the growth stocks, and this could be a long time from now, so I'm going to be patient, buy more into the beaten up growth stocks and hopefully benefit when the next transition occurs. I also think that at this same time, I think it would be a good time to find a second value opportunity so that perhaps I have more diversification in my portfolio, especially away from the high growth stocks that I have a large exposure to. Games Workshop had seen a partial recovery this week with shares increasing by 3.03%. Although this could perhaps be impacted as they did drop a severe amount down to £92 per share on Monday. As I'd mentioned earlier, this stock has been out of favour for a fair chunk of time, at least over the last few months. And I would be perfectly fine if it continues to underperform, as I could use this time to build more equity in the investment, buy more shares and benefit over the longer term in which I think the share price will likely increase. By far, Games Workshop is the stock in the portfolio in which I have the most conviction on. This is because I've been diving deeper into the whole Warhammer Fantasy, End Times and Age of Sigmar. The latter isn't liked too much. But regardless, I can see the creativity aspect of this. I can see that it could easily be applied to a TV series, a film, and I do believe that there's a lot of potential in the intellectual property of Games Workshop, and seeing as they're doing fantastic revenue and earnings growth, I feel that buying more would be a wise idea. Thus, I did buy an additional share of Games Workshop this week on Monday, getting a good value on the price, bringing my total holding to 64 shares and my second largest position in the portfolio. And if you'd like to sign up to my stockbroker Freetrade, you can get a free share worth up to £200 when you use the link in the description down below. The top faller in the portfolio this week was the likes of Team 17, in which shares had fallen by 2.23%. Although on Wednesday they had seen a temporary dip of over 4%, in which I saw a lot of value considering they are still down a lot from their all-time highs, and decided to buy more. I added an additional 17 shares to my position, bringing my total holding size to 155 shares. Although with Team 17, I believe that the valuation may continue to be squeezed, meaning shares may drop further in the coming time period. This is because they had benefited or gained a large share price movement over the last year, and so it would make sense if it retraced a part of that growth. However, I'm happy to continue buying in to average down my position and hold for the longer term. Although their results are due on the 16th, this could be a change in their trajectory, which could mean that shares therefore reverse this trend and go up, or they may drop further. Either way, I want to use this as an opportunity. I'm going to buy a little bit before and buy a little bit after, and if they drop a significant amount, buy a lot more. Although in order to fuel this acquisition, I once more had to sell further shares of Halma, which is a growth stock that is also out of favour in the current market trends. This means I'm likely taking a loss when I'm selling this stock. I managed to reinvest that money into Team 17 when it was £6.60 per share, and it's now sitting at around £7 per share. I believe Halma has a lot of potential for the future, and shares had increased this week by 2.65%, but I feel that this stock isn't the ideal investment for me. As I said last week when I sold 4 shares, I think it's a lower risk growth stock with consistent revenue and earnings growth, but unlikely to rapidly compound my wealth over this short to medium term, in which I seek to increase my risk so that I can build wealth faster, so that then I can look to preserve it when I have more wealth. Halma, great investment, I believe, for a person looking to preserve and slightly grow up on their wealth. And that's where you probably wouldn't invest into a lot of the stocks I currently hold. I also bought 12 shares or a minor amount of shares of Argo Blockchain, as it was the spare change in my portfolio, which brings my position size to 747 shares in my Freetrade ISA and 1,068 shares in my Trading 212 general investment account. Argo Blockchain has an increase with the significant change in Bitcoin price this week, which has increased, and that's due to their share price dilution due to the smart growth acquisition of the land in Texas, in which they get some of the cheapest electricity rates in the world, and it's also renewable. So it's a short-term price dilution with potential for the future to grow a lot more, and thus I'm staying invested for the time being. Although once they get their Nasdaq listing, I will not lie, I'm very likely to cut a majority of my position and then hold a small allocation with Argo Blockchain as my cryptocurrency allocation. As for Boohoo, shares have continued to stagnate, as not only are they out of favor in the current trend from value to the other way from growth to value, but also as they have not seen the likes of ethical investors reinvest into this stock. They've still got a lot to prove on that front, and obviously their governance could still bring up questions which could certainly affect the price in the medium term. I'm happy to be patient, continue waiting this out, as I'm not concerned about the company, and I believe that over the longer term this is a true machine of a growth stock. Providing they're able to maintain their high growth in revenue and earnings, I'm happy to continue holding, even if that share price stagnates, as I will likely buy more. I did say last week that I would be unlikely to buy more shares of Boohoo due to systematic risk, as it's such a large proportion of my portfolio, although I think I was unintentionally misleading. I don't mean that I will never buy shares of Boohoo, but rather I mean that at the moment, whilst it's at a good value in my opinion, I don't think it's worthwhile increasing my systematic risk. However, if it drops to near my average price of around £2.50 per share, then I would be very tempted to be buying more, at which point that would be a good opportunity, in my opinion, to be buying more and increasing my position for the longer term. But if it doesn't do that, I'm unlikely to actually buy more. Shares in Boohoo are dropped by 0.72% this week, and I actually had a comment asking how my portfolio was managing to stay up despite Boohoo dropping by quite a significant amount in the last month. And well, in honesty, this is just because I had been depositing a lot of money over the last 2 months, and thus whilst my portfolio had been falling, I'd artificially been pumping my portfolio up with cash, meaning that it had looked like it stagnated. But in reality, if you'd followed the weekly trends of the portfolio updates, I had continued to underperform and dropped by quite a significant margin. If you're interested in why I stopped uploading videos on YouTube, then click the card at the top right of the video. Thank you for watching, have a great afternoon.